And this chapter 6 is on inventory. And this is one of my favorite chapters because we get to go through a lot of calculations, and almost all businesses do this. All the methods that we're going to cover today are actually used in practice. It's very applicable to doing accounting. And it's also stuff that sort of is, um, it's on the CPA exam and it's used in future areas of accounting quite a bit. And so we're going to describe some controls over inventory, the cost flow assumptions, and how they impact this income statement and the balance sheet. Our cost flow assumptions are FIFO, LIFO, and weighted average cost. And that's how we determine how the goods flow and how the cost gets assigned to cost of goods sold and ending inventory. And we're going to talk about that in the perpetual and the periodic method of inventory, and compare the three inventory costing methods and which will provide a higher net income or a higher ending inventory balance or a higher cost of goods sold in different scenarios, and talk about some of the reporting uh, items of inventory on the financial statements, and then days sales and inventory turnover ratio. How efficiently is a company turning over its inventory and cycling through it? And also using the retail and gross profit methods of inventory costing to estimate or approximate inventory valuation when we don't have a full physical count of the inventory, or when um, we're just doing an approximation, so to speak. And for controls of inventory, this is the business processes that protect the inventory by physically safeguarding inventory from damage or theft, keeping it in the proper storage, keeping it secure. Um, Thinking about the Walmart glass cases that seem to store everything from a brand new PS5 to a $10 light bulb for my car. I don't know why the light bulbs have to be behind the case, but they are. And then also the reporting of inventory in the financial statements, such as making sure that we're calculating LIFO, FIFO, or weighted average cost correctly, and also preventing inventory fraud in certain ways. There have been a few major frauds in relation to inventory, even one I think that occurred at least partially in Minnesota in the 90s, 80s and 90s, where whenever the auditors would come to count the inventory would be shuffled from location to location, and they would essentially be counting the inventory multiple times at all these different locations, and so the inventory balance was inflated. And so there's controls over shipping and receiving documents that sort of prevent that from happening, and that's purchase orders, receiving reports, and the inventory subsidiary ledger. And also shipping documents provide clear documentation of what inventory has come into our possession, what inventory left our possession, what's our what's the inventory on hand at the end of the day. And then this inventory subsidiary ledger shows what are the individual items of inventory that we have on hand, where are they located. Really organized companies will have even like what shelf in the warehouse is it on, and there'll be shelf A1, A2, A3, and it'll be super organized. The more neurotic your inventory warehouse manager is, the better. I've been to so many different warehouses to verify that the inventory is physically there, and the more on top of entering the purchase orders timely, receiving reports, shipping reports timely, making sure everything is organized, and then the reports in the accounting system accurately reflect where is everything, the better. And that's good from a financial statement perspective because we know exactly how much inventory we have. We know we have controls over it. If it goes missing, we know how much we should have even had in the first place. And that's all good from a financial perspective because we know how much money we have. We know how much money in inventory that's there. But from an operational perspective, it's impossible to run a retail business if we don't actually know how much inventory we have on hand or not. Like running a business in an organized manner just It makes everything so much more efficient and essential. Um, And so there's physical inventory counts or counts of inventory. I've done probably over 20 of these different counts. This is me on top of a bunch of grain bins in the middle of North Dakota. And I had to climb up and drop a tape measure down and verify how much grain or beans were in there. And so you measure how full is the grain bin and then use area of a cylinder, and then the USDA provides density factors to show per cubic foot of grain how many bushels of corn or wheat or soybeans are actually in there. And you verify exactly how much inventory is there. And that's really important for the financial statements because if there's 5 million bushels of wheat in here and wheat is $8 to $10 a bushel, that can easily be 40 to $50 million worth of grain in one of these facilities. And so it's really important from an audit perspective to verify that it's actually there. And also from a company's operational and safeguarding of inventory controls, verifying that the inventory is there, it hasn't been damaged or stolen, and that when they agree to sell inventory to customers, they actually have it on hand. They can provide it. They know if they need to get more. Um, and with that, we'll get into the meat of the chapter, which is the inventory cost flow assumptions. And when identical units of merchandise are purchased, it is, and the items have a different cost every time that they're purchased, it is essential to allocate the cost to cost of goods sold and ending inventory properly. And under cost flow is excuse me, different companies will use different methods. FIFO is first in, first out. That means that the units that have been purchased first are the first units to leave and get allocated to cost of goods sold. And so under FIFO method, when we are selling inventory, we take the oldest inventory and that's what's sold. And so you can imagine that all of these little boxes are going, or these little cubes are going into the box. And as they get older, the oldest ones are at the bottom, and that's what gets sold. Under LIFO, the most recently purchased goods are the ones that are sold. And under weighted average cost, we take a weighted average of the cost of all the ones that are put in, and then the goods come out. You could, and the cost is assigned as an average. And it's a weighted average because if we are purchasing these cubes at different prices throughout the period, and in certain orders we're purchasing 1,000, and in certain orders we're purchasing 500, the 1,000 unit order should have a higher weighting when determining the cost. And so um, we'll get into some examples of that calculation in a bit. For example, there's 3 identical units of merchandise. Um, one purchased at $9, one purchased at 13, and one purchased at 14. And depending on which of these units we choose that are sold, we have a different cost of goods sold, we have a different gross profit, and we have a different ending inventory. And so if we take the $9 unit, then our gross profit is 11, our cost of goods sold is 9, our ending inventory is 27 because that's 13 plus 14. Where if we take the most expensive unit, the $14 unit, then our gross profit is much lower at $6, and our ending inventory is also lower because we sold that $14 unit that's not remaining in ending inventory. And another method that was not in the image is the specific identification inventory cost flow method. This is when we know exactly which unit was sold. And this is particularly common, you could think in a car lot, right? Every car has a VIN number. We know exactly how much we paid for every single car. And the cars come in, we add them to our inventory balance. When the car is sold, we the cost of goods sold is the cost that we paid for that particular VIN number of the car. But it gets much harder with something like shoes. Right there, we get a whole bunch of identical shoes in to the store. How do we identify which ones to use? And different companies choose different ones based on some industry factors. For example, grocery stores generally use FIFO because produce and food expires. And so when an item comes in, the physical flow of goods, right, is that the first units that come into a grocery store are the first units that are sold. And so the grocery store is constantly trying to clear out the inventory that's approaching that Best Buy date or the expiration date because they want to get rid of it. And so that's a direct representation of FIFO. And generally they're going to use FIFO. It gets more complicated when it's chemicals or oil that doesn't expire. The units are totally indistinguishable. And in that case, what it comes down to is taxes. In a period of rising costs, like in an inflationary period, the units purchased most recently are going to be the most expensive. And so using those units as cost of goods sold provides a higher cost of goods sold, which is a larger tax deduction because cost of goods sold is an expense. And so it shows the least profit right now. And that's beneficial to companies that want to save on their taxes right now. And generally, the IRS does allow different accounting treatments on the financial statements and on the tax forms. But for inventory cost flow assumptions, they mandate that if you are using LIFO on your taxes, you have to show LIFO on your financial statements to investors as well. Where depreciation methods, the IRS almost requires that you use a different depreciation method for the IRS and for the financial statements. But for inventory cost flow, it has to be the same. And so that's why companies use LIFO a lot of the time. And then companies will also choose weighted average cost for simplicity sometimes, or just because that's the method that they want to use. And so for this particular example with the 9, the 13, and the $14 unit, under the FIFO method, we sell the first unit that was purchased first. And so that's the $9 unit gets assigned to cost of goods sold. Under LIFO, we use the last unit that was purchased that goes to cost of goods sold. And so then that's the $14 unit. And so you can see here that gross profit is higher under FIFO than under LIFO, which would mean that they would pay more taxes, but it also means that they got to report a higher net income. And then under the weighted average method, we add up the 9, the 13, and the 14 divided by 3, we get an average cost of 12. And then the cost of goods sold is 12. Ending inventory is 12 times 2, which is 24. And then we're going to go through a bit more of an illustrative example of this. And for the purposes of this illustration, we're using item 127B. And so this, you could imagine this is a portion of the inventory subledger because it is separated by a particular item, 127B. And so then we know exactly all of these units are identical. And we will have a ledger like this for every different type of inventory item that a company has. And so we have beginning inventory at $20 a unit. And then we have a sale at $30 per unit of 700 units. And then another purchase, 2 more sales, and another purchase. And the costs for each of the purchases are $20, $22.40, and $23.30. And that's a different cost. So we're going to have a different cost of goods sold under each method of accounting. And so this filling out a worksheet like this is going to be identical to what you guys see on the homework. Um, so we have here in this inventory column is for each transaction, what are the inventory layers that we have? And so the first transaction is simple. We have 1,000 units of $20 inventory, and it's 20, so its total cost is $20,000. Then uh, we sell 700 units. And so then this is our journal entry for the sale, right? We debit accounts receivable, credit sales for 21,000 because that's the sale sold at $30 a unit. And then cost of goods sold is $14,000 because this is under FIFO and the perpetual method. So we're recording everything at the time of the sale as we go. So we have a 700 units at $20 a unit because that's the only units that we had on hand at the time was this 1,000 units of $20. Now our updated inventory column is we only have 300 units left at $20 a unit. And are you guys able to see this very well? If you're not, you can always move closer to the screen. And the slides are also online as well. And then when we purchase another 500 units at 2240 per unit, we add that to our layers here. So now we have a 300 units at $20 and 500 units at 2240. And so in this inventory column, we're sort of repeating this, right? So we had 300 at $20. Now we still have 300 at $20, but we have 500 at 2240. And then accounts receivable, here we have. So then we have another sale of 360 units. And under the FIFO method, we have to sell the oldest inventory units first. And so we're going to sell 300 units at $20 per unit and then 60 units at 2240 because we have to use up this inventory layer or bucket first. We have to use up all of that and then we move on to the 500 at 2240. And so then remaining is 440 at 2240 because we sold 60 of those units and we sold all of the 300 units at $20 a unit. And so then our cost of goods sold, we have to add both of these up. So $6,000 plus 1,344 is $7,344 is our cost of goods sold, and then credit to inventory of the same amount. Then when we sell another 240 units on the 28th, it all comes from the 2240 inventory because that's all we have left. And so then we sell 200. This column here shows our cost of goods sold. And so we have 240 units, 2240 per unit, $5,376 is our total cost of goods sold for that transaction. And then our remaining inventory is 200 units at 2240. Then we make another purchase on the 30th for $23.30 per unit. And to get the total inventory here, we have two buckets of inventory now. We have 200 units at 2240 and 600 at 2330. If we add those both up, we get $18,460 is our ending inventory balance. And our total cost of goods sold throughout the period was $26,720. If we add those up, cost of goods sold and ending inventory, it is always going to add up to our cost of goods available for sale. And that is, if we took the amount of the purchases, the total, if you remember from the periodic method, if we take beginning inventory of 20,000 plus the purchases of 11,200 and 13,980, we're going to get about $45,000. That's our cost of goods available for sale. All our inventory cost flow assumptions do is allocate that cost to cost of goods sold and ending inventory. With the fundamental assumption of we had what we started with plus what we bought minus what we sold, and then we have our ending inventory. And then that keeps our accounting equation in balance, the journal entries in balance. Um, exactly. So under LIFO, the LIFO method was originally used in the rare cases where the units sold were actually taken from the most recently purchased units. However, LIFO is now widely used even when it does not represent the physical flow of goods. For example, a grocery store could elect to use LIFO if they really wanted to, um, and it would represent like they could maybe save some money on their taxes if they used LIFO, but it's definitely less common in a clear situation such as that. It doesn't, inventory cost flow assumptions don't actually have to represent the physical flow of goods. But if there's a clear physical flow of goods, it probably should. And then when the LIFO method is used, the subsidiary inventory ledger is sometimes maintained in units only, and the units are converted to dollars when the financial statements are prepared at the end of the period. And this is because the, especially in this example here, under LIFO, we're selling the most recently purchased units. And so the inventory left at the end of the period can be really old. Almost 10, the prices of the inventory at the end of the period can be upwards of 10 years old or more. In And so the cost isn't always recorded directly in the subledger until the end of the period when the accountants sort of reconcile and figure everything out. Um, However, these examples are simple enough that we are totally able to do that ourselves with the perpetual method. There is also one of the most painful, expensive, or high fee generating for accounting firms items is converting a business from using FIFO to using LIFO because they have to go back and sort of figure out what the old units costs were at the time that they going back. I mean, it's a total nightmare. And we won't get into FIFO, LIFO conversions in this course. That would be more of a CPA exam or intermediate accounting level topic. But these methods are used in all of these methods are used in practice. So for LIFO, our initial transaction is the same because the 700 units comes from the $20 inventory because that's all we had at the time. Then we make another purchase and we add 500 units of 2240 inventory. And so we have the 300 units at $20, the 500 units at 2240. When we make a sale of 360 units, this all gets taken from the 500 units of 2240 inventory that can fully be applied to this sale because it's only 360 units. That's less than 500 units that we had. And so we take 300 units times $20 and 140 units times 2240. And that's our ending inventory. That's what we have left. Our cost of goods sold is higher because we're using the more expensive inventory that was more recently purchased. It's $8,064 is 2240. And so then that's our cost of goods sold journal entry. Then on the 28th, we sell the remaining 140 units of $22.40 inventory. And then the 100 units that we still have to account for, that gets used, the $20 inventory gets used for that. And then we make another purchase of 600 units. And then our ending inventory balance is 200 units at $20 and 600 units at $23.30. And so our ending inventory is 17,980, which is lower than under the FIFO method because we still have 200 units of this old inventory that never even got applied to the sale. Like this was in beginning inventory and now it's still in the ending inventory. And then the next month, these layers, buckets, tranches, whatever you want to call them, of inventory will be the beginning inventory next month. And the $23.30 inventory will get sold first under LIFO. And so we have a ending inventory, we have 800 units still, 17,980 in ending inventory. And then we also have the weighted average cost method. And under the perpetual system, we compute the unit cost every single time that we make a purchase. Every single time that there's inventory added to the system, it recomputes a new weighted average for the inventory. And this technique is called a moving average. And the calculations are a little bit more involved, but the actual application of the cost, I think, is more simple than under LIFO or FIFO. And so, and the first transaction is the same because we add, um, right? It's just 700 units at $20 a unit. But then as soon as we add another, then we have 300 units of $20 inventory, and that's $6,000. When we make this purchase here, it's 500 units at 22.40. And so how to calculate, now we have to calculate the new weighted average cost that this inventory is going to be. And so we have another 500 units times $22.40 is equal to 11,200. We have to add all of that up. So we have 800 units here, and we have 17,200 is the total here. And we have to divide 17,200 divided by the total number of units, and we get our new weighted average cost of $21.50. And so then when we sell the inventory, we just apply the cost using our weighted average cost that we just calculated. And so 360 times 2150 is 7,740, and we apply that right to our cost of goods sold entry. And then 240 times 2150 is 5,160, and we apply that to our next cost of goods sold entry. And then our inventory balance is then now we have 200 units at 2150, and that's 4,300 of inventory there. Then when we purchase another 600 units, we start with, we had 200 units at 2150. Oh my God. Equals 4,300. And I do recommend that you guys work along with this because I don't have a video on this particular method, but once you guys get it down, it's going to be really simple to work through. So then we purchase another 600 units at $23.30. And that is 13,980. And so our ending inventory balance is 18,280. That's going to be our ending inventory. But the unit cost for our ending inventory, we have to divide it by the remaining units, and we get $22.85. So with that, that is all of the perpetual methods of computing inventory. Do you guys have any questions on that? Okay. So which of the following inventory costing methods would be associated with the highest cost of goods sold, assuming a period of inflation or rising cost? Come on, I know you guys know it. So we have cost of goods sold is the expense of the item. Exactly. And that's because in an inflationary period, the most recently purchased items are the most expensive. And if those are applied to cost of goods sold, that's the highest cost of goods sold. And the opposite is true in a deflate. And we're going to skip a few of these examples because we have a lot to cover today. But we'll go over the impact to the income statement in a the opposite is true if it's a deflationary period. If costs are going down, LIFO is going to have the lowest cost of goods sold. FIFO would have the highest cost of goods sold because it's all about which units were the most expensive that got applied. And this will really illustrate that under the periodic inventory system, we're recording everything at the end of the period. We're only applying the costs at the end of the period. And you guys remember from last chapter, at the end of the accounting period, we take a physical inventory and we determine the amount of inventory we have on hand. And then that determines our ending inventory balance. And then we compute cost of goods sold based on beginning inventory, how much we purchased, and then subtract how much we have at the end. And that's how much was sold during the period. And we have to have a cost flow assumption, LIFO, FIFO, weighted average cost, when we're applying this method in practice, assuming that the units are identical and they're acquired at different costs per unit. Because if they're different, if they're completely different units, we might want to use something like specific identification, and we could identify the VIN number of the car, or something like that. But if they're and if they're all purchased at the same cost, it wouldn't matter what cost flow assumption we used because we would just apply the same exact unit cost to every unit because we always purchase the unit at $20 a unit. And so this is the same example that we just looked at, where we had an initial inventory of 1,000 units. We purchased 500 on the 10th. We purchased another 600 on the 30th. And the total inventory available for sale during the month was 45,180. And this needs to be allocated between ending inventory and cost of goods sold. So the total units were 2,100 units. We sold 1,300 of them. We had 800 on hand at the end of the period. And under the FIFO method, the most recent purchases will be included in ending inventory. And so we have 800 units in ending inventory. And so first we take the 600 units, and then we take 200 of the units purchased on the 10th. And then that is our ending inventory under the FIFO method. We have 600 times $23.30 plus 200 times $22.40, and we get an ending inventory of 18,460. Then we can compute cost of goods sold by subtracting 45,180 minus 18,460. We get 26,720. We could have also gotten that by taking 1,000 times 20 plus 300 times 2240. We'll also get there because we sold 1,300 units. We have 800 units left. And so all this is just applying the cost between cost of goods sold and inventory at the end of the period. And so I love this graphic here because it really shows how the 1,000 units gets put to cost of goods sold under the FIFO method. This 500 unit purchase gets split between the two, 300 to cost of goods sold and 200 to ending inventory. And then the 600 units all stays in ending inventory. And under the perpetual method, we're calculating every single transaction. We're calculating this as of every single transaction that we do. Under the periodic method, we're just doing this at the end of the period. We're taking the total purchases throughout the whole month or year or quarter or whatever, and then applying cost of goods sold and inventory that way. Under LIFO, we do it a little bit differently. And since this is the periodic method, we had 800 units in ending inventory. We had 1,000 units in beginning inventory. And so all 800 units in ending inventory are going to be $20 unit, $20 per unit inventory because we had enough in the first bucket to satisfy all the ending inventory under LIFO. And so that's going to be $16,000 in ending inventory. We can compute cost of goods sold from that. And so, and it really bugs the hell out of me that this graph is not proportional in the bar charts. But basically, $16,000 is the 800 units at $20, and then we have 200 units at $20, 500 units at 22.40, and 600 units at 23.30 go to cost of goods sold. And then under the periodic inventory system, for weighted average cost, we calculate the total weighted average cost for everything throughout the period, total cost of the units available for sale divided by the total units available for sale. And so in this first, our example here, we add up all of the units that we had during the period. So we had 2,100 units available for sale during the period. And then we add up the total cost of each of those units. So 1,000 times 20, 500 times 22.40, 600 times 23.30, we get 45,180. Divide 45,180 by 2,100, and we get $21.51 per unit is our unit cost of the inventory. And we just apply that 800 units times $21.51 is 17,208, and 2150 times 1,300 units that were sold, we get our cost of goods sold of 27,972. And just because, companies will disclose in the financial statements what method that they're using. And they also, for different business segments, for example, if a business has a retail segment where they sell chemicals and also sort of a wholesaling business for grain, they might use a different inventory cost flow assumption for the different business units that they have. They can separate it. And once again, under the periodic method, at the time of the sale, no entry is made to cost of goods sold. We compute it at the end based on the purchases made throughout the period and the ending inventory units available. And so we're going to take a look at the cost flow methods between FIFO, LIFO, and weighted average cost. And they yield different amounts of cost of goods sold, gross profit, net income, and ending inventory for each of them. Under the FIFO method, in a period of rising costs, FIFO is going to have the highest ending inventory, the highest gross profit, and the lowest cost of goods sold. And then under LIFO, the gross profit is going to be lower because the cost of goods sold is higher because they're selling those newer, more expensive units. And then ending inventory is going to be lower. And again, that's why companies use LIFO. Generally, it's for tax purposes so they can show a lower net income in the current period. And in a period of decreasing costs, the opposite is true. And it is common that there are periods of decreasing costs for businesses. For example, like right now, we're in a RAM shortage. RAM prices are going super high. but that's going to reverse at some point. And then RAM prices will go down. And then for any business that's in the business of selling those components, they're going to be in a period of decreasing costs. And under that period, then the FIFO will have higher cost of goods sold instead of LIFO. And then the ending inventory balance will be higher under LIFO. And just make sure that you guys have the logic for will costs be higher or lower under a period of increasing or decreasing costs. That's absolutely fair game for like the final question and some of the homework questions, and then also on the quiz. And so there's a number of reporting requirements for inventory on the financial statements. And we're recording inventory like we record other assets at historical cost. But sometimes things happen. And if something goes wrong, for example, the inventory is spoiled, damaged, goes obsolete, or is imperfect, and we can no longer sell the inventory for what we originally purchased it for, we have to write down the inventory to what's called its net realizable value. Also, if the cost of replacing inventory is below the recorded cost, there could be a write down for that as well. And this creates what's called a lower of cost or market write down, and it's valued using the lower of cost or market method. And this values the inventory if it is decreased in value for some reason at the net realizable value, which is the selling price minus the direct cost of disposal. And those direct costs of disposal are what's the cost to get rid of this inventory. For example, sales commissions, shipping, things like that. And for this example here, the item originally cost $1,000. Obviously, initially, we purchased this item for $1,000 and we thought we could get something more than $1,000 for it. Because in retail, we're not in the business of buying things and then selling them for a lower price. Like that just does not work fundamentally as a retail business. However, sometimes things happen. For example, this particular item may have gone out of fashion and now we have to put it on clearance, sell it for 800. We have $150 in selling expenses. That might be commissions, delivery, anything like that. And so our net realizable value is $650. And we have to write this inventory item down to $650. And so take 1,000 minus 650, that's going to be a $350 charge. The journal entry is going to be debit cost of goods sold, credit inventory, because that cost just goes to cost of goods sold, and then it'll show up on our balance sheet as the correct amount that we can actually get for this balance. That means our current assets are actually going to be correct, because current assets, they're assets that are going to be converted into cash within a year. And investors really care about current assets because that's how companies are able to generate cash quickly, pay back their short-term debts. And the cost could be determined by we can apply the lower of cost or market method on the inventory at the each item in inventory level, like at the SKU level. This particular item of clothing, just this particular shirt, this particular pair of pants. We can also do each major class of inventory. Okay, this class we're just doing athleisure, we're just doing menswear, we're just doing shoes, but we're aggregating it at that level and then taking the lower of cost or market for that category as a whole. Or we can do total inventory as a whole. And we'll go into the calculations for those in a minute, but I wanted to illustrate how applicable this is to real businesses. Lululemon has a critical inventory audit matter. A critical audit matter is something that gets put on the auditor's report, and the auditor basically says, there's nothing wrong, there's nothing misstated, but this is a particularly complex accounting issue that's particularly risky. We had to think about this for a long period of time to verify it, and investors should know. And so that's a fairly common thing that shows up on a lot of financial statements is a critical audit matter. Sometimes it's related to derivatives valuation. Sometimes it's related to revenue recognition for complex contracts. And so it's not necessarily that like Lululemon did everything right in the reporting here. But this is a particularly like basically what it says is they had to take an $84 million lower of cost or market charge during the period because of items that they could no longer sell for more than they purchased it for. And this is the we made too much sale. It's a little bit old, but basically they made too much of their inventory and then they had to clearance it all out to sell it. And so they needed to make a lower of cost or market adjustment. And $84 million is not a small amount of money. Investors really care about it. And even if it wasn't in the critical audit matter disclosure on the audit report, they have it in their inventory footnote as well. They're like all retailers that have a major lower of cost or market write down, they're going to show in the footnotes, okay, this is how much of a charge we needed to take for that. And investors care about it because it shows how effectively is management ordering the correct amount of inventory. Because if they're ordering the right amount of inventory, they're not going to have to write it down when it goes out of fashion. So now for the mechanics of how it's actually done, we take a look at we're going to have a listing and we're going to have every single unit on the, we're going to have every single unit of inventory and we're going to compare the cost and the market value of the inventory, which is the net realizable value, estimated selling price minus the cost of disposal. And in this particular example here, we have $10.25 cost and a $9.50 net realizable value. That's 75 cents per unit that we need to write down. And so it's 400 units. That's going to be $300. That's this top example right here. So it's $4,100 cost, $3,800 market value. And then the lower of cost or market is 3,800. And this is also an example of taking the inventory lower of cost or market exercise at the individual item level, at the applied by class and applied in total. And so you can see comparing each and every item. We take the lower of cost or market for each. Here we have class 1 and class 2 inventory. And so under the separating it by class, we add up the total lower of cost or the total cost and the total market value for both of these items. And we take the lower of cost or market. And that's going to provide a slightly higher inventory valuation than here, because in here we're writing down all the inventory values specifically. When we're grouping them, some of the losses are offset by some of the more profitable items. This is really only allowed for expediency purposes. If we don't have time to declare every single SKU and how much should every single SKU be written down or not written down, we could do it by class and say, okay, well, we're going to do menswear on this category and shoes in this category and all these sort of different items. And then as a whole, we just do it in total. We add up the total cost and the total market value. The applied by the individual item amount is definitely the most accurate in practice. On the homework, you will have all three methods will be on the homework. Anyone have any questions on lower of cost or market? Okay, you guys are pros. So reporting inventory on the balance sheet. It's a current asset, and uh, that means it's going to be converted into cash within a year. And the notes to the financial statement say, how was this inventory valued, FIFO, LIFO, or weighted average cost? And then also, did they use lower of cost or market? And if there was a substantial write down under lower of cost or market, they're going to disclose how much that was. And so this is Best Buy's inventory footnote and current assets section on a somewhat recent 10K, which is an annual report. They had 5.9 billion, right? Because it's in millions. So 595,000 is actually 5.9 billion in inventory. And then they say they use weighted average cost method and lower of cost or net realizable value as their inventory valuation methods and assumptions. And I don't see a particular statement that they don't say what their lower of cost or market write down was, so we can assume that it wasn't very high, um, which is interesting. So any errors, and right, what companies use for their inventory cost flow assumption, it's somewhat determined by the actual flow of goods, but it is a lot determined by industry as well. Like, what are their friends doing? So oil companies are almost always going to use LIFO method of inventory because the physical cost flow doesn't really make a whole lot of sense when they're just adding oil to a vat and then taking oil out of a vat. It doesn't act, the physical flow of goods probably would most accurately match weighted average cost, but they just all use LIFO for tax purposes. And that's just industry practice. And so to compare easily among peers, they all use the same method. Occasionally will be a somebody that deviates from that, but that's how companies decide. There can also be errors on the financial statements, such as physical inventory was not counted properly, costs were incorrectly assigned to inventory using cost methods such as FIFO, LIFO, weighted average, right? It just did not calculate properly. Or inventory in transit was incorrectly included or excluded from inventory. That also aligns with sort of our revenue recognition principles. If we are the retailer and we're selling items FOB destination, that inventory is still in our possession until it gets to the customer. And so we have to make sure that we're including that. We have to make sure that we're not recognizing the revenue until the inventory actually gets to the customer. That's when we've satisfied our performance obligation. It's a contractual term, but it's also an accounting revenue recognition term. It's looking at what service did we actually promise to provide? What's the exact point in time that we provided that? Also, consignment inventory was incorrectly included or excluded. So merchandise ordered FOB shipping point, that's our inventory the moment it gets on the truck, but we don't actually receive it until um, you know, maybe a couple days later when it actually gets to us. And we have to make sure that we're properly including inventory in transit that is in under our legal control. And so there is a reconciliation done after year end. We take a look at all the shipping documents and determine what inventory was shipped to us before the end of the year. And also for inventory that we're selling FOB destination, we have to determine at what point was it actually delivered to the customer? Was it delivered before year end? Do we get to recognize that revenue and then take the inventory out of our control? And so in practice, at the warehouse level or the factory level, they will do a physical inventory count and they will count only the inventory that is actually there at the plant. And then there will be an accrual for FOB destination inventory and FOB shipping inventory that we're going to receive. Um, And this timing difference is incredibly important. I was just looking at just because I'm interested in stocks and investing, I was looking at C.H. Robinson's annual report. And they're a logistics company. They own trucks. They ship stuff all over the country. And one of their critical audit matters, like Lululemon had the lower of cost or market thing, they're a shipping company. They don't actually earn the revenue until there's various points at the contracts where they say you earn part of the revenue when you're halfway there, or you might only earn the revenue when the product actually gets delivered. And so they don't actually own the inventory that's on their trucks, right? They're just shipping it from one point to another. But the critical audit matter was at what point do they recognize that revenue? Because it's all about timing, and they have to estimate how much revenue could be in transit, and it was a lot. It was in the multiple millions of dollars, like maybe even I want to say it was almost $300 million of in transit trucks just for their shipping business. And then they have to determine exactly when it arrived to determine how much revenue they need to recognize. So that was sort of the complexity, critical audit matter there. There's also consignment inventory. This has to be excluded from inventory because the manufacturer, called the consignor, retains the title until the goods are sold. There's also consignment stores around where we can take items to that store, and then we still own it until the store sells it, and then the store takes a cut, and then we get the money at that point in time. So that needs to be excluded from ending inventory. And if inventory is overstated in the current period, we're overstating our assets, overstating our equity in the current period balance sheet. We're also understating cost of goods sold because of, right, ending inventory has a direct relationship to cost of goods sold. And then that also overstates our gross profit, overstates our net income. After a year or a quarter or whatever, in the next period, the balance sheet is going to be correct. But that beginning inventory was wrong. And so our cost of goods available for sale is going to be overstated, and our gross profit, our cost of goods sold is going to be overstated in the next period. Gross profit is understated. Net income is understated. It's all a timing issue. Everything will eventually even out. And so if we do not properly accrue our inventory in one period, the balance sheet's going to be wrong this period, but correct the next period. But at least 2 statements of income, at least 2 years of income statements are going to be incorrect because of this error. And it's the opposite balances for amounts that are understated. And we looked at this when we were taking a look at the Under Armour fraud, where they were recognizing revenue too early. They had gotten money from customers, but they hadn't really earned it yet. And so they were pushing deferred revenue into the current period from the future to meet analyst growth estimates. They needed to make that. And then eventually that income comes from the next period into the current period. So the next period's net income is going to be lower because of that. And eventually it caught up with them, and people were fined and lost their jobs and things like that. So we'll talk a little bit now about the inventory turnover ratio and days sales in inventory. And this is a measure of how efficiently is a company using their inventory, and managing the inventory that they have on hand. And so inventory turnover is cost of goods sold divided by average inventory. We get our average inventory by taking the beginning of year inventory plus the end of year inventory divided by 2. And in this example for Best Buy, We can see year one, two, three. Um, their inventory turnover ratio is slowly increasing. And generally, higher is better than the inventory turnover ratio. That means they had a higher cost of goods sold and less average inventory. And inventory has a cost to hold. There's warehousing costs to the inventory, um, but there's also costs of capital impacts, right? This is a lot of money that's tied up in inventory. So for Best Buy, it's $5.9 billion is tied up in their ending inventory. And if it wasn't in inventory, it could be in cash and they could earn interest on that cash, or they could use that cash to pay back debt or declare dividends to investors. And so, there is a significant cost to holding working capital. And we could even think of that as if we were going to start our own retail business, a huge startup cost is purchasing all of the inventory and then selling it later. So that's a barrier to startup costs sort of thing as well. Um, the flip side of this is days sales and inventory. And so we take our average inventory divided by our average daily cost of goods sold, which is our cost of goods sold divided by 365 days. Um, and so we could write this out as, you know, average inventory divided by cost of goods sold divided by 365. And this really it shows in days how many days of inventory do they have on hand on average at any given time? And how long does that inventory spend in their possession? And so lower is better for uh, days sales and inventory because, right, the inventory turnover ratio was increasing because it's turning over more times per year, but their yearly days sales and inventory was going down from 57 days to 52 days. And different industries will have vastly different inventory turnover ratios and days sales and inventory. If we think about Kroger, they're a grocery store. All their inventory expires. They have to sell it. They have to move it quickly. And so their days sales and inventory was 28 and a half days. Um, where Best Buy, their part of their business model is having all the electronics on hand. So if something goes wrong, you can just go there and buy a new charger, a new mouse, a new computer, a new laptop, something like that. But they have to have that on hand in order to sell it. And their margin might be a little higher too, especially on expensive items. And so they can afford the extra cost of holding inventory for longer, and it's a business necessity for them. So if we think about like, let's just by show of hands, who's heard of just-in-time inventory? Okay. So some of you have heard of just-in-time inventory. Basically, it is um, a manufacturing concept where especially common in cars, where all the inventory arrives at the last possible moment. They use it to build the car and they ship it out as quickly as possible. And this reduces the amount of inventory on hand at any given time. So they don't have to spend money on warehousing all this stuff. They don't have to spend money keeping track of all of it. They don't have to um, keep that money tied up in inventory. It can be in cash. It can be used for anything else in the business, right? And so from a cost perspective and a supply chain efficiency perspective, having a just-in-time inventory where everything is electronically ordered and arrives at the exact possible moment that they need it is amazing when things go perfectly. And this was super common up until COVID happened. And then supply chain issues started happening. And it's really hard, right? When they're not holding very much inventory on hand, then they're out of something and production stops. And we had the chip shortage in like 2021 and 2022. Car companies, they're missing a single part and they can't finish a car, right? So there's the ideally inventory should be kept as low as possible while still having enough inventory on hand to make the sales that are necessary and so that production doesn't stop when there's some sort of supply chain issue. So there's a resiliency to efficiency and cost trade-off. Can also think of it too, like I think higher margin businesses generally hold less inventory on hand. For example, like a like luxury bags, like Gucci bags or like diamond stores. They hold a lot of value in their inventory on hand because when somebody comes into the store, the margins are too high. They cannot afford to miss a sale. And so the value from a business point of view is so high to have everything on hand that they could possibly need that they might have a higher days sales and inventory on the chance that somebody walks in and needs something because they can get the profit from that sale. And so for now, we're going to get into the retail method and the gross profit method of estimating cost of goods sold and ending inventory. And this is used if perpetual inventory records are not maintained, uh, they have a disaster that destroys the inventory records and the inventory, or there's monthly and quarterly financial statements that are needed, but a physical inventory is only taken once per year. And so what we can do is estimate the inventory. It's much less scientific than the perpetual or periodic methods we were doing before. Um, and what we do is we determine the total merch. So for the retail method, what we do is we determine the total merchandise available for sale at cost and at retail. Then we divide the retail price, we divide the cost by the retail, and we get a ratio of cost to retail. So in this example, we had inventory at the beginning of the period was 19,400. We purchased 42,600 in inventory. The retail price of this inventory, or the sticker price, or the sale price, or whatever it's going to be sold for, was $100,000. And so our ratio was 62%. And that's not the exact markup, but it is like that's correlated, right? Like that's the markup on our inventory. And so we know we had 70,000 in sales. And so we take 100,000 in merchandise available for sale at retail, minus the 70,000 in sales, we get $30,000 in inventory at retail that's left over. And then we have $18,600 in ending inventory because we take 30,000 times 62%, and we get 18,600. So it's it's a very quick and dirty estimation because we're using this when we don't actually have the inventory records of what has happened. But we want to estimate our ending inventory and our cost of goods sold. And we can estimate our cost of goods sold by taking the merchandise available for sale at $62,000 minus 18,600. We can get our cost of goods sold from there. Under the gross profit method, we calculate the gross profit first. And so we take at cost our initial inventory plus our purchases. We get our merchandise available for sale at cost. Then we have our sales of $250,000 for January, and we multiply that by a gross profit percentage to estimate our gross profit. And we determine this percentage, in this case 30%, based on previous quarters. We go back for previous quarters, couple of years, we say our gross profit percentage has been 30% every year. We're pretty confident that that's what it is. And then we can use this to make monthly or quarterly financial statements without actually physically counting all the inventory at the end of every month, because there's a huge cost to that. When when an inventory count is done, generally production has to stop because we can't keep putting more inventory in and taking more inventory out. We need to get an accurate count, right? But that's losing money. Anytime the machines aren't running, that is money out the window, right? So this is a much more efficient way to compute gross profit or ending inventory on sort of a monthly financial statement level. And then we get our gross profit of $75,000. That means our cost of goods sold is $175,000 because we take sales minus gross profit as our cost of goods sold. And we take merchandise available for sale minus cost of goods sold, our estimated ending inventory of $62,000. So just for another example here, if we determine that the ending inventory at retail is 1,235,000, then the ratio of cost to retail is 54%, then our ending inventory is 1,235,000 times 54% is 666,900. Another example here, we can estimate based on the following data, what is the cost of inventory on June 30th. So we can take our total cost of inventory. So we take the cost of 165 plus the 2,361,000. And then we take retail cost of beginning inventory plus purchases. And we get our total cost. We subtract our total sales. We compute our ratio of cost to retail price by taking the total retail value of merchandise available for sale. And that's the denominator. And the numerator is the cost. And then we get 62% is our cost to retail ratio. We take sales minus we take our retail merchandise available for sale minus sales. We get 525,000 of June 30 inventory at retail price. Then we multiply it by a ratio of 62%. And we get our ending inventory at cost of 325,500. And under the gross profit method, this is an example here. We're estimating the cost of the inventory destroyed. So there was a fire. We don't actually know how much it's impossible to even count the inventory. It was all destroyed in a fire. We have to determine how much was there. And then we're going to estimate this using the gross profit method. So we had sales of 4,440,000 times 35% is a gross profit of 1,554,000. And that means our estimated cost of goods sold was $2,886,000. And so we take our merchandise available for sale minus our cost of goods sold, and we can estimate with reasonable certainty that our ending inventory was $414,000. And an insurance company would look at this and just validate that our gross profit percentage was the same as a bunch of previous periods. And they would say, okay, this seems really reasonable. This is the amount that we'll approve for the insurance claim for the fire. And it's also really useful for when the company is reporting, like, oh, hey, investors, there was a major fire at one of our plants. It cost us a lot of money. They can actually put a quantifiable dollar amount. Okay, how much did that fire cost you? And that's really useful to disclose because they're required to disclose material events like that. If something horrible like that happens, they have to issue some sort of a press release that talks about it. And so now what I want to do is just go through a few examples in the homework of the inventory of basically the examples of what we're doing in class. So is there a particular method that you guys would like to go over? So LIFO, FIFO, or weighted average cost. I know some of this is not making sense. Like I know there's a lot to go over here. Okay. Um, yeah, yeah, I'll do weighted average. Um, let's see. So under this example, we'll do weighted average cost under the periodic. Mm, no, I want to go to this different example. Okay, we'll use this example here. Oh my God, there's so many of them. Okay, we'll do this example here. This is a good weighted average cost example. So at the beginning inventory and 3 months of purchases are described as follows. We're using the periodic method. So we're adding up everything and then we're determining what we have all at once at the end. And so we'll do this under all three methods, but we'll start with weighted average cost. And first we have to determine, we're given all these purchases and sales, but we have to determine how much was actually, what was the total here of all these amounts on a unit basis. And I think it's easiest to just maybe bring this up in Excel. And so when problems are complicated like this, it can be really useful to bring them up in Excel. And so for inventory available for sale, we had 1,000, right? We had 9,000 units to start at $60 per unit. And then we had a purchase of 21,000 at 70 a unit. We had, and we'll just do the purchases first and we'll do the sales later. So then we had another purchase of 39,500 at $75. We had another purchase of 25,000 at $82. And then a purchase of $10,000 units at 88,400 or 88, sorry, $88.40. And we can get the cost. The reason I'm doing this in Excel is to simplify the calculations here. What was the amount for each one of these? And because this is under the periodic method, it's important to calculate. So this was our beginning inventory here, this 9,000 units, and then each of the items, and we get the total cost of goods available for sale. And I believe I got all of the purchases here. So then our sales, and we'll do this on a unit level too, and it's important to note the sales price because under each sale it says, for example, 10,250 units at $140 per unit. That's the sale price, but that's not actually the cost of the inventory. But we need to know this because it's asking us to compute what the total sales was and the total gross profit as well. So we need to keep track of that. So then we take 5,750 units and we had 140 a unit. And then we had 3,500 times 140. Then on February 16th, we had 15,000 units at 750. Wait, no, 150. Then we had another 10,000 units sold at 150 a unit. And 30,000 units sold at 150 a unit. And then on the 30th, we had another 19,000 units sold at 150 a unit. And if you can press Alt plus, that's the formula for summing. I'm really good at Excel shortcuts. It is a very useful skill when working in accounting. Just here. I just want to make do accounting for the dollars here. And then we also want to make sure that we take the sum of the units because that gets us the total units purchased and available for sale and sold. So then if we take the units available for sale, which was our beginning inventory plus all four of our purchase transactions, minus all of these sales transactions that we had 27,000 units in ending inventory. There we go. See, that's why it's also useful to use Excel, because you can sort of see things like that. So thanks for catching that there. And I will mistype. I will say things wrong. So please, when you guys notice that, let me know. And so to assign a weighted average cost for this inventory, because we're doing this on a quarterly basis. We're doing this for the entire quarter. To get our weighted average cost, we take the total cost of the inventory available for sale divided by the total amount of units, and we get $75.66. And I'm not sure if it tells us if it has particular rounding instructions. For round weighted average unit cost to the nearest cent. So that's really important when we're dealing with so many units that we have to round it to the nearest cent. And Excel will not do this automatically. For example, if we go there are some additional decimal points if we do not round to the nearest cent. So we need to make sure that we're rounding to the nearest cent here. And so we know our ending inventory has 11,000 units. So we can take 11,000 times 75,066, and I'm writing this out manually just so that it so that it's rounded properly. And we get 832,260. And then our cost of goods sold, we have to multiply our unit cost we have to multiply the units that were sold multiplied by $75.66 per unit was our average cost per unit. And if we added those two numbers up, 77 million 74,000 plus 832,000, that's going to equal our 7,906,000 in cost of goods available for sale. We're just allocating the cost between the two units, so to speak. So let's just make sure that that's correct before we go any further. Okay, so our cost of goods sold. So troubleshooting here, if we know that the inventory balance was correct, maybe this is different. Okay, this was part of the rounding. In order to tie this out, oh, I copied too many times. Multiplying, it has to tie, right? So it says under the periodic method, we determine our ending inventory first, and we determine our cost of goods sold by taking ending inventory minus cost of goods available for sale. And in this case, there is a $30 difference because of the rounding that we did. And that's where my error was there. So make sure that your ending inventory plus your cost of goods sold equals the total cost of goods available for sale. That's very important. So there's that, it's only a $30 difference because it was, right, there were those extra decimal points. It was 75.66003. But when we're dealing with millions of dollars here, it sort of matters more. And so when we're computing our cost of goods sold, we need to put that in our balance here. You can calculate ending inventory. And then our sales is the amount of sales that we had. Which is 13,000 here. And our gross profit is our sales minus our cost of goods sold. And that we have to make sure that we're using the amount that we calculated. That's really annoying. What is going on here? Oh, see, this is, it says for the boxes in which you must enter subtracted or negative numbers, use a minus sign. And so that is, it'll always say that in the question if a minus sign is necessary. So that's a common question on the quizzes. It's how do I know whether to use a minus sign or not? I know that there were some examples in the previous, in chapter 5, where in the homework there were no minus signs allowed, but then on the quiz there were some minus sign applicable problems. And that's a common way to trip up right there. So, but it will say, and if you ever have questions on, why was this wrong or things like that, the solutions are posted after the homework due date, and you can always email me, and I'm happy to look into it for you. So now that we have everything written out, it's rather straightforward to calculate FIFO and LIFO methods for this as well. And so under the FIFO method, the ending inventory on hand are the latest units that were produced because the inventory that was sold first in, first out, the old units were sold first. So we know we have 11,000 units of ending inventory. And so our ending inventory balance under FIFO, we're going to take EI is for ending inventory, cost of goods sold is for cost of goods sold. We're going to take 11,000 in ending inventory multiplied by the most recently purchased units. Oh, we can only take 10,000 from the most recent purchase. So we actually need to take 10,000 from that purchase equals 10,000 times 8840, which is going to be this 884,000. And we add 82 times 1,000 because that's the amount of additional units from that area, that bucket that we need. We get our cost of goods sold by taking goods available for sale minus our ending inventory. So our ending inventory here should be there. Our cost of goods sold is 6,940,000. And then we have to enter that as a negative for our cost of goods sold here. Our ending inventory is the same. Our sales are the same as weighted average. And so our gross profit is, and we can also insert another one. Our sales were the same amount as here, and then our sales minus cost of goods sold is our gross profit. Under LIFO, we have to take our 11,000 units first from the beginning inventory, which was 9,000. Then we have to take another 2,000 units from the first purchase at $70 per unit. And so we can do that on our spreadsheet here. Start a LIFO column. Our ending inventory is going to be the entire balance of beginning inventory, which is 9,000 times 60, plus 2,000 times $70, because that was the second purchase. And so our ending inventory is 680,000. And then we take cost of goods sold minus or we take our goods available for sale minus ending inventory, and we get our cost of goods sold. Our sales is the same, and then our gross profit is sales minus cost of goods sold. Does anyone have any questions on how this all works? I do want to briefly go over the perpetual homework methods. And this is all going to be for the same problem, but it's much less Excelable because it's all sort of in the same balances here. Oh, and then, okay. So that is it for this problem. But I just want to briefly touch on another one of these problems. So that's how to compute weighted average cost for these. You should be familiar with weighted average cost in the perpetual method like we went over on the slides as well. And that would basically be computing this weighted average cost that we did up here where we multiply all the goods available for sale, we get the total quantity, we get the total cost, we divide out, we get a weighted average cost per unit. You should be familiar with doing that under the perpetual method as well. This is a worksheet, much like what we were looking at in the slides. This is using the LIFO method, prepare the inventory for this. And so every single transaction, we are going to be writing out the quantity, the quantity, the cost, and then a total. And I'm not going to write the totals because we don't have a ton of time. But basically what we're doing here is whenever we purchase a new inventory, we're adding that layer. So we have another 21,000 units at 70 a unit. And then we get 21,000 units at 70 a unit. Or well, actually, we're going to add that in. We have to repeat the 9,000 and the 60. And we show that first because that was inventory that was purchased first. And this is just how we sort of keep track of it in a ledger format or in a spreadsheet format. So then we have each of our purchases here. Then when we make this initial sale, we sell 10,250 units. And it's his last in, first out. So this is going to be $70 inventory that's sold. And so then now we repeat the 9,000 inventory at $60 a unit. And then we have 10,750 in inventory left at $70 a unit inventory. I think I added that up right. And so you'll continue to repeat every transaction. You'll be writing out what was the inventory units amount and how much was assigned to cost of goods sold, and then what is remaining in each layer of inventory. And this is the perpetual method, so we're recording everything as we go. I have an example video going over this more in depth, so make sure to check that out if you need some more help. So yeah, thanks everyone. That's all for today. I'll stick around for questions.